Continuing on with consolidation adjustments then, our next adjustment on consolidation would be eliminating the provision for unrealised profit, shortened to PUP. Now, in the last session, we saw the dilemma of when the parent sells goods to the subsidiary, and at the year end, the parent showing an outstanding receivable due from the subsidiary, and the subsidiary showing an outstanding payable due to the parent. And we said we needed to eliminate those balances because from the group's perspective, they don't exist. Remember the single entity perspective. Now, another complication you could face in the exam is that what happens if the parent sells goods to the subsidiary, or vice versa, but the parent makes a profit on the goods that they sell to the subsidiary? Well, essentially what we have to do here is eliminate the unrealised profit, or what I like to call the fake profit. It's not real profit, okay? If the parent sells goods to the subsidiary for $150 and the parent made $50 worth of profit on those goods, well, that's not real profit because we didn't sell those goods to an external customer. All we are effectively doing is transferring goods between the group companies, but making a profit each time we do. But it's not real profit from the group's perspective. It's only real profit when you sell goods on to external customers. All we're merely doing is just transferring goods between group companies at a marked up price. So it really is just an intercompany transfer of goods at a profit. Now, if that's the case, then that profit that the parent is showing must be eliminated on consolidation. It is not real profit, okay? All you're doing is taking goods from the left hand and transferring them to your right hand, yeah, and making a profit whilst you're doing so. It's still within the single entity. So if you're making a profit from transferring things from one hand to the other, it's not real, it's fake. It's unrealised profit. And that's what we must eliminate on consolidation. So, we can see then that as the notes read, when goods are sold by one company in a group to another in the same group, a cancellation would be required to remove, in accordance with the single entity concept, the receivable and payable amount on the statement of financial position. We saw that in the last session. But if these intercompany transfers are done at a marked up price, that's going to reflect the fact that they are separate legal entities. They need to make commercial sales. They need to make a profit on them. Now remember, since we view the group as a single entity, this profit must be identified and in turn eliminated. One person can't make a profit from trading with themselves. And if you're making a profit by buying and selling goods within the group, that's effectively what you're doing, making a profit with yourself. It's not real, it's fake, it's unrealised, we must get rid of it. So, usually what you'd be asked to do in the exam for a multiple choice question is you'll be asked to calculate the unrealised or fake profit. Okay? So, usually businesses can apply a profit markup or a profit margin. Do you remember markups and margins for incomplete records? Well, that's coming back into play here. We need to work out the amount of profit and how it affects the group financial statements. So, there's two really important things to consider before calculating the provision for unrealised profit. And these items you must learn. The first point is you must determine the direction of the sale. Did the parent sell to the sub and therefore the parent made the profit? Or did the sub sell to the parent and therefore the subsidiary made the profit? So you must determine the direction of the sale to determine who made the profit. Okay. Did the parent make the profit on selling those goods, or did the subsidiary make a profit on selling those goods? That's what we'll have to ask ourselves first. The second point that we need to establish before we calculate the fake profit, the unrealised profit, is to determine the amount of sold inventory left within the group at the year end. So let's say then that the parent sold goods to the subsidiary in the year, and they sold 100 units, let's say, and made a profit on those 100 units. Well, if then the subsidiary sells on 50 of those units to an external company outside of the group, well, then a real profit would have been made on those 50 units. And that wouldn't be the problem. The problem would be the profit on the goods remaining in the inventory of the group at the year end, the remaining 50 units. So, if the parent has transferred 100 units of goods to the sub, and the sub then sold on 50 of those units to an external customer, that would have made a real profit. But the other 50 units still in stock at the year end, well, that still has that fake profit that the parent made attached to it. So we always have to apply unrealised profit to the amount of goods left within the inventory, because that would be the unrealised profit. If you've sold those goods on to external companies, that would be a realised profit, a real profit, a true profit to the group. Okay? So remember, we're viewing the group as one, as a single entity. You only have realised or real profit if you sell goods outside of the single entity. You have unrealised profit if you're making a profit on transferring goods with one hand in the other, the parent and the sub. All right? So you must consider those 2 points before then proceeding to calculate the unrealised profit, the PUP. So the best way to go through this then is to do a few examples to get a feel for how this could be tested. So our first example then on PUP. P sells $100,000 worth of goods to S, an 80% subsidiary, at a cost plus 25%. And in brackets there you can see that that's meant as a 25% markup. Remember, markup's always based on cost. S has not sold any of the goods outside of the group by the end of the year. Required. Calculate the PUP and show the double entry for this transaction. Okay, so the first thing we do is determine the direction of the sale. So, who sold to who? So, for our example then, step 1, who sold? Sub to parent, parent to sub. Well, the direction of the sale is the parent sold goods to the sub, and therefore the parent made the profit. So therefore the parent made the profit. So what we're saying is if the parent made a profit on selling the goods to the subsidiary, the parent's accumulated profits, their retained earnings, would include the profit they made from selling the goods to the subsidiary. That's not real profit. We need to get rid of it from the parent's retained earnings. Okay? So we need to remove from P retained earnings. This is a statement of financial position adjustment, and profits form part of equity, and profits for a limited company are known as retained earnings. So parents' retained earnings are too high. We need to take them down and get rid of the profit they made on selling those goods to the subsidiary. The second step is establishing. So we need to establish then what amount of goods are left within the group at the year end. Let's look back at the example then, and it says S had not sold any of those goods outside of the group. So all of the goods that the subsidiary received from the parent, the subsidiary has not sold on. So in this case, all of the goods are left within the group. So all of the goods are left within the group. So we've done those two key exam considerations. Now what we must do is we must calculate the PUP, and that will be the third thing we do. So step 3, calculate PUP. Remember the provision for unrealised profit, shortened to PUP. Now what we need to do is establish our cost structure. Okay, we'll do this in thousands, I think. We start off with the selling price or transfer price. You can call it selling price if you like, but I like to think of it as a transfer price because that's merely what it is. A transfer of goods between the same entities at a profit. Yeah, so it's like an internal transfer of goods from the group's perspective. Compare that to the original cost to the group to give the PUP, the unrealised profit on that transfer at the bottom. Now, we know that the profit the parent made on selling those goods was 25% markup. And do you remember the cost structure for a markup? It's up on cost. So we base 25% on the cost. And therefore the cost would be 100 and the transfer price would be cost plus the markup percentage, which was 25%. So the transfer price must be 125%, which means then that the unrealised profit is 25% of the cost. Now, what else do we know? Well, we also know the transfer price or selling price of the goods left in inventory, $100,000. $100,000 of goods was sold to the sub, and the sub would have recorded that in their books, and it is still left within inventory at the year end. So, all of the goods that were sold at a selling price or transfer price of $100,000 remain within the group at the year end. Now, do you think you'd be able to calculate the PUP from there? Hopefully you remember how we did this in incomplete records. So let's get our calculators out. We take 100 with a figure we know, the transfer price, divide it by 125 that it relates to, and times it by 25 to isolate the profit, the unrealised profit. So running that through your calculators, you should get an unrealised profit of 20, which means the cost is 80. So, what does this mean then? Well, if the parent company applied a 25% markup to the cost of its goods, it sold goods to the subsidiary for $100,000 and made a $20,000 profit on those goods that they sold. Now, that is a fake profit on those goods left within the group. As soon as the parent would have recognised the sale of those goods, profits would have increased, and therefore accumulated profits would have increased, retained earnings for the parent would have gone up by that 20,000. That's not real from the group's perspective. We need to get rid of it. So step 4 is to do the journal, to eliminate PUP in the Consolidated Statement of Financial Position, the CSFP. Remember I said that I'd abbreviate it to. So, we know that profits are a credit balance because your income exceeds your expenses. Now what we need to do with that is we need to debit and reduce the selling company's retained earnings. Now that's what we considered in step 1. The parent made the profit and therefore the parent's retained earnings are too high. We need to take that down. So we're going to debit and reduce the parent's retained earnings by reducing group retained earnings. Do Do you remember then that the parent's retained earnings is the first figure when we do the working for group retained earnings? We did that a couple of videos ago with our first example. So, parents' retained earnings are in the working, we'll just put a W there, are in the working group reserves. And what we must do is take the parents' retained earnings and then minus the unrealised or fake profit, which was $20,000. Okay, because remember that's where we saw the parents' profit in group retained earnings, which was our final working when we were doing our consolidation workings. Now, there has to be a credit. Now, think about the subsidiary. The subsidiary would have received goods from the parent at a cost to them of $100,000. Okay? So the parent would have recognised a sale of $100,000, but the subsidiary on the other side of the coin would recognise a cost to them of buying that inventory of $100,000. Which means if that's the cost to them, that's what they would recognise the value of their inventory at the year end. The value of their inventory that they have in stock is $100,000. But that's the cost to the subsidiary, not the cost to the single entity, the group. And as such, we must reflect the cost of the goods originally suffered from bringing that inventory into the group in the first place. And that would have been the cost to the parent. Okay? Now, do you remember the term with IAS 2, inventories? We saw at the very start of this course. Inventory must be valued at the lower of cost and net realisable value. Net realisable value, selling price less cost to sell. Well, if you think about it, the subsidiary would recognise a cost to them of $100,000, but from the group's perspective, it's the net realisable value, it's the selling price. We want the value of the inventory to be at cost, the cost to the single entity, to the group. Therefore, the subsidiary's inventory, which is included in group inventory, is too high. We need to take it down. So, the credit will always go to reduce group inventory. The subsidiary is recording the inventory asset at 100,000. They should be recording it at the original cost to the group of 80,000. Therefore, we need to write it down and credit that asset down by 20,000. So what would happen then is when you do your CSFP and you have the line inventory, remember, inventory is an asset and that's under control of the parent, so we would consolidate parent plus sub. Well, we take parent plus sub and then minus the provision for unrealised profit, in this case of 20,000. So that entry will always be the same, whether parent sold to sub or sub sold to parent. Because parent and sub's inventory valuation are included within the group inventory, so the PUP will always come off to bring it down to the original cost to the group of that inventory. Okay? And that's how you deal with PUP. Okay? Pop it into your group retained earnings working as a deduction from the parent retained earnings, and then reduce group inventory. All you've got to remember on top of that is the first two exam considerations: who made the profit, how much inventory is left, and then you need to be able to apply markups or margins in order to establish the PUP. So what we've seen here is the parent selling to the sub at a markup. Well, let's have a look then at when the sub sells to the parent, and we'll also recap margins as well. Let's have a look at another example on this. Then. The next example. In the post-acquisition period, Sally's sales to Polly were 50 million. So after acquisition, Sally sold goods to Polly for $50 million, on which Sally had made a margin of 5% on these sales. Do you remember a margin is based on selling price, whereas a markup is based on cost? Of these goods, $7 million at selling price to Polly were still in the inventory of Polly at the year end of the 30th of September 2011. Polly holds a controlling interest of 70% in Sally. So that would make Polly the parent and Sally the subsidiary. Required. Calculate the PUP and show the double entry for this transaction. All right then, let's have a go at this. So, our second example then on provision for unrealised profit adjustments. Well, first thing we need to consider, who made the profit? Did Polly sell to Sally or did Sally sell to Polly? Well, this time we've got the sub, Sally, selling to the parent, Polly. Okay, because they told us Polly was the parent and Sally was the sub. So the sub is now selling to the parent. So therefore, the sub made the profit on those goods that were sold to Polly, the parent. Now, that would mean then that the subsidiaries' retained earnings are too high at the year end. Now, do you remember where we used the subsidiaries' retained earnings in context of the workings for the consolidated statement of financial position? Think back to when we did that large example. We used the subsidiaries' equity balances, retained earnings and share capital to establish what their net assets were at the year end, compare them to what was there at the start to show growth post-acquisition. Well, as a result then, the subsidiaries' retained earnings would need to be reduced with that profit that they made on selling the goods to the parent. So we would reduce sub-retained earnings at the year end, so the CSFP date. And we use the subsidiaries' retained earnings in the net assets list working. That's where we use the subsidiaries' retained earnings. And if you remember, in the net assets list, we had at acquisition, at CSFP, at consolidation. Well, at the year end, the subsidiary would have recognised profits, retained earnings, of which some of those profits includes profits made from selling goods to the parent. Fake profit, unrealised profit. We need to strip it out. So this PUP adjustment would come off in the at CSFP column in the net assets list. You might want to take a look back at that example we did first of all to refresh your memory on that. So that's the first step. Identify who made the profit, and this time the sub made the profit on selling to the parent. Step 2. Amount of inventory left in the group at the year end. So, let's have a look then at the amount of inventory left at the year end. Well, if you notice then the second sentence, it says, of these goods, 7 million at selling price to Polly were still in the inventory of Polly at its year end. So there's $7 million worth of goods left in inventory at the year end, out of a total of the the 50 million that was sold. So then, now we've established that, let's do step 3 and calculate the PUP on those goods left in inventory. So we only calculate PUP on the goods left in inventory at the year end, not on the total sales. So 50 million was the total sales. 7 million of those goods are left in inventory and would have that fake profit. The other $43 million worth of sales Well, they would have been sold on by Polly to an external customer and therefore would have made a real profit, a realised profit. We're only interested in the profit that's in the goods still left within the group. So, calculate PUP. And we shall do our cost structure. And I think I'm going to do this in thousands rather than millions. Transfer price or selling price, cost, and then the PUP dropping out the bottom. We know that the sub made a profit margin of 5%, and that's based on selling price or transfer price, which means then that the other 95% must drop down into cost, and the other 5% will drop down into profit. Remember, margin inside sales. Of your sales revenue, how much drops down into profit? Inside sales. So this time it's a profit margin. We have been given the transfer price of the goods left in inventory at $7 million. Okay, not the total 50 million, just the 7 million. Always based on the goods left in inventory. We know that 5% of that is going to drop down into profit. So all we can do there is take 7 million at 5%. Margin should just take 5% of the transfer price, 350, which means the original cost to the sub and therefore the cost to the group was 6,650. Yeah, 6,650, the original cost to the group. So the calculating the PUP element is really just making sure that you're happy with markups and margins. Step 4. Journal. Like we did up here. Eliminate the PUP. The unrealised profit from the group accounts. So from the CSFP. We need to eliminate it. It's fake, it's not real. From the group's perspective, we must get rid of it. So, a debit and a credit entry then. You thought debits and credits were over now, but unfortunately they're not. They do extend a little bit into group accounting. Now the debit is going to reduce the profit in the selling company's books. Who sold the goods? Well, it was the subsidiary, and therefore the subsidiary made the profit. Their retained earnings are too high at the year end. We must reduce them down. So we're going to reduce sub-retained earnings and if you remember, we use the subsidiary's retained earnings in the net assets list. So we're going to reduce net assets at CSFP column in our consolidation workings that we saw in earlier videos. And again, please go back and have a look at that net assets list. You will be minusing $350,000 from the at CSFP column underneath the retained earnings at the year end for the sub. And that's why the direction of the sale is important. We need to establish who made the profit of $350,000. The credit then will always go to reduce group inventory. And that's because the parent's inventory is too high. They would have an inventory balance at cost to them of $7 million. However, the original cost of those goods left within the group is actually 6,650. So in order to take it as from 7 million that it is down to 6,650, we must minus 350,000 from the group inventory. So again, when you do your consolidated statement of financial position and you consolidate inventory because all assets are under control of the parent, parent plus sub minus PUP. So it doesn't matter who's sold to who in terms of the credit entry. If you have an unrealised profit on inventory, you minus it from the group inventory. Now, that's all we really need to learn with PUP. So there's a couple of more small scenarios in your notes for you to have a go at on PUP. And there's also some larger questions at the end of these study notes, which deals with the full consolidation that you saw earlier, also with some intercompany trading and some PUP adjustments thrown in as well. Okay. All I would recommend is that you do any adjustments for intercompany trading or PUP before you do your standard workings. Net assets, goodwill, NCI, group retained earnings. Do these adjustments before then, and then everything will filter down. Okay? Full answers are in the back of your notes. Work through them nice and slow and make sure that you're happy with the adjustments and the consolidation process, and then we'll move on to our final consolidation adjustment, which will be fair value adjustments in the next video.